back from lunch. One of the questions that has been bubbling in the background is, where is the money going to come from? To help us answer it, we have three remarkable investors and a fantastic financial journalist. Those of you who don't know Una Galani, you must read her stuff on Reuters. Can I ask all of you to come on board? And Una, would you do the introductions, please?
Yeah, makes sense. Yes. Split it kind of.
Well, good afternoon, everybody. Yeah, where is the money? Well, we've heard from the startups, and now we're going to hear from the investors. Climate investment in India has become synonymous with some very big names. We're thinking of big corporate houses, sovereign wealth funds. We know that Adani and Ambani are committing a lot of energy and resources to driving down the cost of green hydrogen. We know that the sovereign funds in Singapore and Abu Dhabi are aggressively funding renewable energy projects, grid scale ones in the country, and you'll hear about some of those later in the industry panel. But all of this will help India decouple its growth story from emissions. But there are also lots of opportunities out there for investors with more measured risk appetites and investment timelines. So, most of the money today is going into electric passenger vehicles, renewable energy, but the very, very big emitting sectors, such as logistics, manufacturing, freight, agriculture, these are all in dire need of some more funding. So what lessons can we learn from some of the investors that have actually put their money to work? We are lucky to have three people here with us today to dig into this question. We have in the middle, Anjali Bansal, the founder of Avana Capital. We have Dhanpal Javari, the vice chairman of Everstone Capital. And at the end, we have Samir Shah, the Peak Sustainability Ventures. So, maybe each of you could just take a minute or two to introduce yourself a bit better than I have, talk about your fund and your investment thesis. Maybe Anjali, Samir, we can start with you.
Yeah, hi, good afternoon to you all. And thank you for inviting me to this panel. So at Peak Sustainability Ventures, our investments are only in sustainability. And we define this as being under four verticals. One is new energy, which talks about everything other than fossil fuels. And there we cover battery management technology, green hydrogen, looking at energy efficiency, looking at various innovations happening in energy. The second one is agriculture, where we try to talk about plant proteins, regenerative agriculture and various areas in that. Third is water, where we are looking at companies which are solving sort of SME-related wastewater recycling issues, drinking water problems, and also some very large companies, which even we invested were small, but today have become very large companies in the water space. And the fourth is climate tech, where we look at plastics, we look at climate tech. One of our companies basically looking at global data analytics on, basically measuring the impact of various actions. And we invest at the Series A level, and we work very closely with founders in terms of how we build a company to take it to the next level, where a large corporate comes in or a large investor comes in and then takes it forward. But we are very much hands-on, work closely with companies and work with innovators. And it's been an inspiring journey since 2017, 18. Since then, we have been focused only on climate. So.
Anjali.
I'm Anjali Bansal. I'm with Avana Climate and Sustainability Fund. I want to start with first thanking EDF. What a phenomenal gathering of people, ideas, technologies, and just a treat to listen to John Doerr. I think he summed it up so well when he said, climate science is the new computer science, which is the tagline for us at Avana, that sustainability is the next digital. We are an early stage technology fund. So we are a tech focused fund investing in climate and sustainability. We look at it from three sectors: These three sectors combined are 90% of emissions coming out of India. Also big users of resources, so water, for example, and big part of the Indian economy. Why India? Because there is no climate solution globally without India. We are the second largest population, the youngest population, the fastest growing economy. We will consume more. And by the way, we also have, in my view at least, somewhat biased, the most exciting entrepreneurial ecosystem with phenomenal founders who are seeing the opportunity in climate and sustainability as we do, who are committing the next 20 years of their life. And we have a benign policy regime. So the three sectors we invest in are energy transition and resources, which include land, air, water, waste, and everything from decarbonization to carbon capture, sequestration, credit, as well as battery technologies. The second one is mobility and supply chain. So energy is 40% of India's emission, mobility and supply chain about 15 to 18%. We have probably one of the most inefficient logistics supply chain systems anywhere in the world, so low-hanging fruit for efficiency. And third is agriculture and food security. Food security, agriculture is critical to India's success and survival as a vibrant economy and society. 50% of our population is still involved with agriculture, large part of our economy. We are very dependent on monsoon. And we are seeing the outcomes of that, right? We've seen wet bug temperatures in Delhi touch 35 degrees this summer. So we'll go on, but these are the three sectors we invest in. We are early stage, tech first and tech focused, pre-series and series A investors.
Una, thanks a lot. And thanks to EDF for having me here. In fact, as I was mentioning, EDF has a pretty interesting name. It's called Defense in the middle. And the way I think about it is, I think climate has to be an offense strategy. We are kind of using that in the way we are building our business out. So a little bit about ourselves. Everstone is one of the partners in setting up a renewables company called Lightsource BP. Lightsource BP currently is building a renewables portfolio globally of about 30 gigawatts. And we've partnered together to set up a company called Eversource Capital, which has raised possibly one of the largest funds, single country funds in the developing markets. We closed that last year with about $750 million. And I would say the primary objective is really to drive and catalyze capital at scale into the climate sector. We believe with this capital we raise, we should be able to put an overall equity and mezz and debt and all put together close to about $4.5 to $5 billion of capital to work in the climate sector in India. Now, when we look at the size of the problem or the opportunity, as I think about it, the way we kind of realize that the only way to kind of make this happen, given where the entire investing opportunity is in climate in India, is to really do it through what we call a controlled growth strategy. So the way we have designed our fund is two themes around which we are putting capital. One is around energy transition, which I look at the use of energy, everything from generation to application. And second is around resource efficiency, which is really about how do we use energy and other forms of resource more efficiently to basically what we call reduce, reuse, and recycle. So through these two themes, we've got many sub-sectors and sectors that we put capital to work, about 7 companies today, out of which 5 we've set up ourselves. We own 100% of these businesses, and 2 where we've essentially bought companies, we own a majority, and we essentially build these businesses through them.
So I think there might be a lot of people who are wondering about what is the reality of investing in climate tech like. We know that VC investing period is quite a risky endeavor. We know that technology, particularly now where we are in the tech cycle, is a risky endeavor. And we know that climate is almost a new and a slightly foreign concept to us. We're all still getting comfortable with it. So when you think about climate tech investing, I mean, maybe each of you can give your perspective, but are the returns lower? Are the investment horizons longer? Is it the same as investing in just a tech fund or something else? What are the challenges? What are the different considerations that you have to take into account? Anjali, why don't you start?
So let's rewind 30 years where digital was not a thing. Most companies didn't have a CTO other than technology companies in the valley, right? And there was maybe an information officer. Today, every single enterprise function is digitized or digitalized. So you cannot imagine a modern enterprise without digitalization embedded as a horizontal. We are sitting today on climate and sustainability at that point. So returns are very good. I'm hesitant to share what our returns are, but they are very, very good. There is science, there are market-ready business models, and then there are platform plays. And I think today, sitting here, you'll see all of us, we do different things. Yes, it is a frontier market in some ways, but it's a very well-supported frontier market. There is enormous demand within large enterprises for solutions to solve for their own net zero targets. And you can't achieve net zero just by offsets, right? Offsets is just moving accounting entries. So you really actually have to solve the underlying problem. So enterprises want that. Consumers, for the most part, do want it as long as you have affordable solutions. Governments around the world have committed net zero targets. In our own country, Honorable Prime Minister's Panchamrit framework lays it out very well. Where will the solutions come from? The solutions will come from technology, innovation, entrepreneurs. We screen 200 ideas every quarter. So there is enough activity. It's where you invest at what stage. So there are early science investors who are the incubators, universities, R&D, a lot of government projects. India itself has, in the last budget, the finance minister announced thematic funding for certain areas. Then folks like us come in, right? So we are Series A, Type 3, Series F, Series A investors where it's market-ready business models. We are not science investors, but we are also not platform investors. So we help companies scale and grow. We have our own unique way of doing it. We recognize the absolute requirement and the value addition. So we are very full stack business building support to our companies. We are thesis-led investors. So unlike most venture investors, we don't do multiple investments in the same space. So we are very thesis-led. And then we work very closely with them. We bridge the spaces between startups, large enterprises where the adoption happens, piloting, sandboxing, and scaling up. The policy space, we are very involved with policy as well. And particularly climate and any new market requires policy enablement. Fortunately, we have a fairly benign, forward-looking, supportive policy regime that is also looking for input. So I think folks like us can add value there. And then catalytic finance, catalytic funding, which kind of completes the virtuous flywheel for us at Avana. That's what we do.
How do you build that capacity to invest in such a lot of different sectors, right? I mean, everything, climate tech can be anything, but you're looking at so many different things. How do you build a capacity within a single small fund to be able to do that?
You want me to take it? Let me answer your last question first. So I think, look, it is a challenge. And I think for venture capital, we are looking forward rather than looking backwards, in the sense that there is a learning curve that always has to occur. So currently, for example, lithium ion, I give this as an example, is a lot of the tech evolution has happened. Now, the time to be spent for venture is in grid storage capacity to say, look, how are we going to solve the grid problem? Particularly as, the percentage of renewables grows in the grid and you have to consider intermittency issues, et cetera, in the grid. Or how are we going to solve the plastic problem through alternative materials? So we developed thesis on alternate materials. We have spent, I've read 3,000 pages on hydrogen to just say, look, how is a green hydrogen revolution going to affect it? Today it's 2%, so it's immaterial. But in the 10 years, it can be a substantial part of how we address decarbonization of steel and cement. So I think you have to think forward. I think innovation is where I think we spend the time and the effort to understand what is going to change the future. I think venture investing is not mature investing, which means that there is a tech risk, as you rightly point out. I mean, the last 15 months, we would have screened about 1,400 companies doing climate. So there's a large set of entrepreneurs out there as well. I think screening well at the initial level solves a lot of problems. So anybody who is looking to do Me Too, we don't generally consider, but people who are doing bold things, we would like to support. And many of the companies that we have worked with, have done well. I think we will go to examples as we continue the conversation. But I think the point is to say that, look, technology is a risk, but we have assumed it. B, I think in climate tech, you are not selling technology alone. It's technology embedded in a solution that is applicable to people, in the sense that, to give you an example, one of our companies does resins, which purifies drinking water. And effectively, we serve about 900,000 people today, over 400 installations, but you don't sell the resin. The resin is embodied in the community system, which is sold as, it's not sold, it is sold or, are bought by a local community. So you have to understand the tech closely, and very simply put, if you don't understand something, we don't invest in it. So we have our sectors which we know well, and there may be situations where we don't understand it. And we say, look, if you don't understand it, there are enough things we know or enough things we know about, and there are enough interesting opportunities in that space. So we let go. But the important thing is where you own the risk, and that's come up to 25 years of experience in investing across various sectors, to say you need to know the risk you're investing in and assess it and see how you work together with the companies. I think to your first question, I think we are seeing substantial returns in climate tech. We also see this as a space that requires concentrated effort, and a fund doing it where they do multiple different things and also climate actually makes the problem even more complex, because you have to think in terms of the solutions that are needed in climate, and the opportunity that is there in this sector is so vast that we actually don't want to look anywhere beyond climate tech to find the investments that we need to have for our fund. And the returns have been, on a risk-adjusted basis, significant. The only other last thing I would add is that for us to invest, it has to be two parameters. One is obviously it has to have significant expectation of risk-adjusted returns, and we can talk about that. The second is positive externalities, and that is a key factor. To say that, look, in a solar company, for example, one of our companies is their software is being used in 100 countries today to look at how do you optimize solar solutions or water, as I mentioned. So without positive externalities, it doesn't fit our mandate. So both these A plus B are independent benchmarks that need to be met by a company whom we invest with. And on the time horizon, we have seen spectacular returns in a 2-year period, but otherwise, I think the 5 to 7 year period is reasonable. I don't think this needs to stretch to 12 years. Maybe, so the fund life we are considering is 8 years, which is a reasonable period. And I don't think that needs to be extended. I think it's a reasonable period for, achieving the results. And then after that, the company then goes to the sort of larger corporates to take things forward, because they are then become a mature technology. And our focus is to see how we get people who are, as Anjali mentioned, outside of the labs and beginning their journey to a level where effectively, Ion Energies from our portfolio just sold their business to Endurance Technologies for $40 million. So now it's a mature company and they will take the business forward. And our journey, we step back after, 4 years of effort with the company.
Well, it's great to hear that there are some exit opportunities as well, always as an investor. I mean, obviously, both of you are slightly at the earlier end of the investment curve. Danpal, maybe you can tell us about how you think about the investment cycle and the returns.
So, Una, I think, the venture space is a high risk and hopefully a high return space is what they expect out of it. But if you look at, and if I look at the climate problem as a larger problem, where a lot of the problem has to be resolved through building infrastructure. On one end, we have seen over the last 10 years, the fact that renewables now have become the lowest cost of energy, of any other levelized cost of energy, of any other type of fuel, is fast driving a significant amount of global capital into that space. As a result of which, we're seeing returns getting compressed because the technology's got stabilized, it's got highly scaled, and the business models are getting largely commoditized, right? So it's becoming more of a financial engineering strategy rather than really about, underwriting technology or business or market or any of those kind of things, right? It's good because the need for capital in that space needs to be maybe 100x of where it is today, right? And you need to have the ability for attracting those trillions of dollars of pools of capital, which are sitting within the pension and insurance and the large endowments and the sovereign funds, to move into that space. because the more classical forms of infrastructure clearly, have the limitation in terms of what's the available opportunity. And then you start thinking about putting a lot of the kind of early, what the VCs are doing in terms of, as Anjali and as Samir have talked about, bringing technology to markets and creating, business models or proving those business models in the market space, is the ability then to take it and apply capital at scale to rapidly deploy it across use cases, markets, and solutions there. So that's where, again, I think we are maybe in the early stage of that whole gold rush. There is a real opportunity out there, and it's being driven in a kind of I would say, through a bi-direction strategy. One is clearly government is playing a very, very key catalyst role. Regulations are supporting that, the early, I would say, mover advantage in terms of subsidies, etc. What we are seeing on the manufacturing PLI, what we are seeing in the whole FAME to regulations around electric mobility, and more recently, as they're trying to build the business case for green hydrogen and battery swapping and all of the other business models we're talking about. But the second and more important, I would say, factor is that you're changing the way in which you're delivering services, using technology and real assets, and more innovative business models in the way you access customers and markets. And that's where I think the real excitement is going to come into the space, is that how do you change buyer behavior from thinking of buying a vehicle to really buying mobility services, from thinking of buying an air conditioner to buying cooling services, from thinking about basically setting up a water purifier to really buying clean water. And as you start unitizing all of these, you're looking, I would say, going to see many new business models come in and delivering that. And that's where I see the excitement.
So is all of this, we're talking about asset light types of investments, or are they asset heavy?
You will have to invest in assets. Are we on?
Yeah, we're on.
You will have to invest in assets because there's no way to deliver anything without assets. But it's what I call infratech, and infra services. At what part of the spectrum you really want to play, and there will be a lot of digital and cloud and tech and science, because a lot of these things is going to change, right? We were just talking about agriculture, and one of the key inputs is nitrogen.
Yeah.
And the way we're going about trying to deliver nitrogen into the soil, right? Now, finally, we're thinking about doing it in a way where we will do it through the air, right? Capture air and water and convert to hydrogen, convert to ammonia, and then basically deliver it to the farmer to, put it as a nutrient in the soil. So there are many ways and that requires massive amount of infrastructure, massive amount of market access, and then finally unit cost, which the end consumer, the farmer, is going to basically pay for and not feel that, they're not economical there.
So before I'd like to talk to each of you about some of your specific investments. So you can kind of walk us through how you got comfortable with those investments. And but before we go there, how do you deal with technology risk? Like the idea that advances in technology could be such over the course of your investment fund. We said like 5, 6, 7, 8 years. How do you sort of mitigate for that? How do you protect yourself from that? How do you think about that? Samir?
Yeah, I could go first. So I think, look, you identified technology risk as a key risk factor. To be honest, that is a risk factor and an important one. But the execution risk and the regulatory risk and the incidental risks of building a business are also equally important. So when we get involved, we work with the company closely to see how we can, throughout the life cycle of the company, ensure that they are remaining at the cutting edge and continuing to invest and build in technology. I think the best way of managing risk is to ensure that you are investing in the right company. So through our team and through a very, I would say, distinguished advisory board, who we have the privilege of, who have joined us, we evaluate companies very deeply. So I think the starting point is to ensure that, before you invest, you have done your work to see that this is a company and this is a technology and this is a founder who you want to back. And once that decision is done and they're a portfolio company, I would like to speak to this question through Ion Energies. So every 3 weeks, me and another individual by the name of Sushil Jivrajka, we met him every 3 weeks for 3 hours on a Saturday. This is a significant commitment of time, building the company and seeing how you deal with mobility. And I think you asked me about technology risk. So, the way we think about it is that in the context of the battery, for example, you deconstruct the battery and you say, look, what are the components? And you say the cell is the domain of the large manufacturers, which require $1 billion investment. The form factor is not a tech investment. The IoT is easily available. So focus on the battery management system, which is the brain of the battery, and allows operating efficiency and thermal efficiency. And some of the fires you are seeing in EVs are where this has been compromised. So you identify the right technology, and then you work with them to say, look, should we do battery swapping? Should we do battery management? How do we, and going with them to companies to actually close contracts. So that's how we eliminated the business risk. We were involved in them acquiring a company in France, which leapfrogged the technology and got a backdoor entry into the EU. So there are 55 clients globally. So I personally, given my background, engineered worked with the founder to close this transaction. They were the first company, and today the only company who has received monies from Amazon Climate Fund. And as I mentioned, now there is an exit of one division, but you have to work with them closely, and there will be risks. I think the important thing is this is a business where in venture capital, you have to have nerves of steel. This is not a bond investment where the government is going to give you their 6% yield but this is what leads to 8x, 10x returns in investments. And I think if you know the space, you know the sector, and you have the experience, which we believe that over a period of 25 years, over many markets, we have that. We are able to deal with the experience, deal with the technology risk, and work with it, seeing the opportunity. In fact, the question we ask ourselves is, if this guy succeeds, how big can it be? Because the check size we write at this stage is, unlike Dhanpal, a smaller check size, because they are come out of the lab and we are building the technology. They are not infra plays yet, and we are not investing in infra plays. So at this stage, catalytic capital is a must, but it is not the only criteria. You need to have funds who work with them, as Anjali mentioned, and we do as well, to see how you build great companies, and you have to have an understanding of the space. So it's almost like building a thesis, understanding the space, and then investing to mitigate the risk in a significant manner. But it is not eliminated. I mean, risk is never eliminated in an investment till you exit and get the money in the bank. So.
Well, it's interesting, isn't it? Because obviously in the solar space now, we think of it was a big invention, and now it's a sort of highly commoditized sector. I speak to some people who say, "Oh, it's very boring. I don't want to talk about that. Let's talk about something new." And
can I respond to the solar? Just a quick 1-minute response, if I may. So I think, look, solar. I agree. Renewables or panels are being, they are, as Dhanpal said, becoming commoditized. So the company we are evaluating currently, or the companies we are looking at, for example, one in the portfolio is a company called Wari Energies, which has grown from 300 megawatts to 5 gigawatts. So they have the two technologies in solar that are still actually requiring venture investing. One is what is called perovskites, and the second is basically HGT, heterojunction technology. So there is innovation happening at the margin. The other one is solar thermal, which we are currently evaluating a company in Austria, which is actually saying instead of glass, we're going to replace it with plastic, which reduces capex by 55%. So in fact, the trip is involved to visit Vienna to see what they're doing, but that is the kind of things we need to do to push the edge in terms of technology. And if this comes to India, in India, the use of thermal in industry application is so huge that this can play a major role in solving that problem. Sorry, I just wanted to respond to that.
Let me pick up on
yeah, please do.
So, 3 things. One is, I think, as Dhanpal mentioned earlier, we need all kinds of capital in this space. And capital that comes in at different stages will have different return expectations. So obviously, the earlier you come in, and I'm not talking about philanthropic capital, which is very much required, but that's not what any of us do here. There is the early science-based, lab-based funding, which is also different. So venture requires a higher rate of return for obvious reasons. But you also have to think about blended finance. So there's late-stage equity, Dhanpal mentioned MES. I think there's a big room in India really for green financing on the debt side as well, which is not what we do, but we are very involved in several conversations. I sit on the board of Tata Power, and I have seen the journey where your new unit of solar is actually cheaper than a new unit of thermal, except that we do have vast amount of already in the ground thermal capacity, which will not turn overnight. For us, as we think about knowledge, and it is impossible to know everything about everything. So being thesis-led investors in our three sectors, we are followers of trends. So we track trends in India and globally in a very significant way. We do proactive thesis building in each one of our spaces. So, if you're looking at carbon, we will look at all the companies that are looking at carbon today. Water, we do the same. Regen Ag will do the same. And similarly, if it's grid storage, off-grid storage, we will talk to everybody. We supplement that. So there's research, there is a lot of market mapping, proactive discussions. We are very well supported. In our team itself, we have deep expertise either in operating or investing in each one of our verticals. So years of experience, people who have invested in mobility, supply chain, energy transition work, the early energy transition work. It's supported by our advisory board, and we have a number of experts on our advisory board, plus our expert circle of founders and science people around the world. So that's how we create knowledge, because without knowledge, you cannot build conviction. Our conviction, and there absolutely will be technologies, new technology and disruption that happens. We want it to happen, right? So new technologies should disrupt the old ones. Business models take time to scale, not 12 years, thankfully. It's a 3 to 5 year cycle for a business model to get your PMF, to get business model to scale. And that's where we play a role. We play a catalytic role. We help them accelerate the go-to-market, the revenue models. And it could be as simple as controlled growth environment, food production. So I know we'll talk more about our specific company subsequently, but we've looked at every single sort of quote unquote hydroponics play over the last sort of 5-6 years in India and the world globally as well. And we couldn't find something where the unit economics were scalable at affordable cost prices that are required for scale in India till we found Iki Foods. Iki is using a patented growing chamber. So they've actually got a patent, material science-based growing chamber, 300% more yield per acre, 80% less water usage, fully circular. And they're growing tomatoes at 8 rupees a kilo in the desert of Rajasthan. Amazing. So if they can grow tomatoes at 10 cents a kilo in Kota, they can grow that in the GCC. And it's not premium leafy greens that appeal to people sitting in the room. This is everyday Bharat ki sabzi being sold at mandi prices. Tomato, Karela, Bengan, Dudhi, Tarai, it's things like that, and we have seen this summer what happened, right? Massive food shortage. If you have heat, 40% of fresh in India gets wasted. So technologies that are solving real problems will have a market. They will scale. We will help them scale. And obviously great founders who are passionate, committed to solving that problem.
Yeah, I love the fact that you're doing this work in agriculture, because obviously, and we'll talk about mobility as well, but I mean, it's a sector that you don't think of as being one that is going to earn you any big returns. I mean, it's typically neglected, rural incomes are very poor. So there's a lot of good that comes from enabling that part. And it's wonderful to know that it's profitable too.
It's profitable. We have another company which that is actually enabling commercial vehicle, EV commercial vehicle adoption by small fleet operators. So your 1 ton, 2 ton series, which are the backbone of Indian intracity trade. Your small vehicles, the Tata Aces
like
that move around. Yeah, like a tempo, right? Yeah. So your big intercity logistics will eventually go to alternative fuels. Hydrogen, which is sort of 1 billion plus investment, is the realm of the Tatas and the Reliance and the Adanis. It's not for us. It's not venture, right? It's not even growth for that matter. So it's not, so intercity will go there. 2-wheelers are getting financed by the OEs. 4-wheelers, as the market grows, and Anish, we heard from Anish as well this morning from Mahindra. What happens to these small fleet operators? They're all MSMEs. You do not have financing. You do not have data. You talked about battery management systems because nobody knows what the residual value of a battery is. What is the second life of a battery? So Turno is doing exactly that. It's a company that is growing superbly. It's giving us terrific return, and we shall see where it goes.
It's nice to see you so excited about your investments.
Yeah. I can talk about distributed storage, right? Which is a big problem in adoption. Adoption problem is storage because, when it gets dark, even though India has a lot of sun during the day, at night, what do? So you need storage. Till you have massive storage farms, there are companies that are working on distributed storage. So there's a lot of different ways of I won't say skinning the cat, but cutting this particular apple. And we want to find some fun ways to do it.
Dhanpal, maybe you can talk to us a bit about the bets you've made in mobility. I mean, when we think about climate tech and mobility, we think of Ola, we think of the huge electric two-wheeler factory they've been making. But you have gone in and you've done a partnership that is with the state governments, and it's about buses, which is not very glamorous at all, because especially, I mean, even if you see the electric buses rolling around Mumbai, they're not glamorous things. They look like they've been on the road for 50 years already. So maybe you can tell us a bit about, how you got comfortable with that kind of investment.
So the best thing about non-glamorous businesses are they make money,
Yes.
right? So you want to be non-glamorous as long as you're making money. But to look at we think about it, there were 3 or 4 things really that happened there. One is that the government came up with this, regulation, which finally, I think, addressed one of the key issues of how do you solve the urban transport problem, but at the same time apply electric, by essentially creating a framework for a public-private partnership, which allowed the contract, which is the core of any PPP, to become bankable. The second was that they used the subsidy that they provide for every vehicle that is bought for this contract as an incentive for state governments essentially to drive electrification of their public transportation systems. And the way it was being provided through a structure where only once the bus actually got deployed was the subsidy being paid out. What that did was, as we know, one of the biggest problems, which everyone over here has kind of talked about in bits and pieces, is that you're essentially selling the fuel, almost, I would say, 80% of the fuel cost along with the vehicle, right? Because the batteries are the 40 to 50% of the overall cost of the vehicle. And the guy who's buying the vehicle really doesn't want the battery. He really wants the fuel, which is the energy to be able to operate the bus. So what this subsidy does to a large extent brings down that so-called upfront cost for the vehicle, which means that the cost to deliver service comes down dramatically. And it's got to a point where today a private enterprise can actually acquire the vehicle, deploy the entire infrastructure around that vehicle in terms of charging and depot and other ecosystems, operate it, and even then provide it at a significantly lower cost on a per kilometer basis than what a state government entity, what's it called, a state transport corporation, basically would be operating these vehicles at. Which means you are essentially driving a change in consumer behavior where it's not only better from an urban pollution and all of that perspective, but it's also much more efficient from a cost perspective. That, in my mind, is the key switch, where if you look at it, one of the most, other than solar, if you look at it, one of the most successful programs recently has been the deployment of buses, electric buses in this whole public transportation ecosystem. Now, having said that, I think the real problem is not that. That only solves 10% of the mobility problem in India. If you look at surface transportation, it's essentially the railways, which are perennially overbooked, or increasingly, as the airline sector has got completely privatized, it's the airlines which are essentially providing very, very low-cost travel and mobility services. But both the railways and the airlines don't solve for the last-mile connectivity. And we're adding about 4,000 kilometers of road network every year. And if you look at it, that the last mile, or I would say a lot of intercity travel, is yet being fulfilled by 15,000 bus operators, completely unorganized, and post-COVID are completely, pretty much financially constrained to be able to do anything to convert that sector into electric. We see a massive opportunity and a gap in the marketplace today where one can actually provide clean, cheap, efficient, and safe travel in the bus space. And therefore, this business we built not only caters to the government sector, but it's increasingly now starting to focus on the private sector.
That's interesting. So how many buses are there now?
We set this business up literally from scratch in 2019. Today we have 700 electric buses operating. across 17 cities in India. And by the end of the year, we'll be at close to about 1,500.
And and you said it can be applied to other sectors now, in the private sector. So what do you mean?
So if you split mobility into personal and mass mobility, I think both Samir and Anjali touched upon the fact that mass mobility, both for passengers and cargo, is clearly where we see is the inflection point for electric mobility in India. So whether it's two-wheelers, three-wheelers, four-wheelers, or even larger commercial and passenger buses, etc., there is an ability today to deliver services using electric vehicles, which are competitive and in many cases even more cost-effective than your diesel or other forms of fuel. Right now, what can you do? Lots of business models are coming up over there. So besides what we've done on the bus side, we've actually gone and bought a company which was the first electric corporate employee transportation business. It's a company called Lithium Urban Technologies. Again, post-COVID, offices essentially got shut. The business went into a little bit of a, I would say, hiatus in terms of corporates not having employees come to work. As it came back, we bought the business earlier this year, and we already had about 800, mostly Tigor and some Mahindra e-Veritas kind of vehicles. And we've just placed an order of 5,000 vehicles with Tata Motors to supply more, to grow that business out. Now, there is real use cases, real deployment at scale, and a lot of capital to be made, to be deployed and returns to be made over here. So I do believe that, and I understand that a lot of people looking at this electric mobility from a financial perspective. I think the entire ecosystem is being developed today in India because batteries is a key issue. Electric vehicles is a key issue. All of this at a price point which kind of makes sense from a consumer's perspective. The charging infrastructure today is almost non-existent. There is a huge opportunity in building charging networks, but the problem is who's going to pay for it upfront. But there is a charging as a service model, which I again believe will develop. Battery as a service, we've just, Government of India has just launched battery swapping regulations. Very early, I don't think it works the way it is today. But there is a whole financing ecosystem which has to kick in, which is where I think this whole battery as a service model and charging as a service model will come in there. So mobility, I believe, is going to be an exciting space. All of us are going to look at it in very different lenses, but all trying to address the same problem that India has to go electric, and I think it should go electric.
Yeah, and what's the, how important was it with this investment that there was that sort of that PPP, like the government end demand was there? Did that help you, make you very comfortable with that investment?
I think for the next 10 years, you're only going to replace demand, not even add to the new demand. There's that much opportunity in India. At the same time, if you look at any vehicle penetration data, right? India today has 20 vehicles per 1,000 people. Europe is at 600, US is at close to 800 today. We'll never get to that point because it doesn't make sense to try and just replicate. In fact, you got to add mobility. And that's where I think a lot of the business model is going to shift from being manufacturers. India is, the third largest manufacturer of autos in the world, largest of two-wheelers or maybe second largest. And all of that manufacturing capacity, I think, has to migrate into more newer mobility models which support the need to not having to, build a 10x, 20x, auto or a, similar market over there.
Okay. I'd like to, does anybody want to talk a bit more about a particular investment? Because I love these stories. They really bring it to life for me. But
yeah, if I may, so I think as Dhanpal mentioned, mobility is clearly a very important sector. But I think one has to realize that, look, India today has about 400 gigawatts of capacity. And ultimately, the power in the grid is coming from fuel, which is fossil fuel, up to 75%. So theoretically, the electric mobility is giving you the benefit of renewables as a percent, but otherwise you're not greening the ecosystem to that extent. I think one, just to comment on your point, after mobility, the next is steel and cement. So that's something we have been looking at closely. And one of our investments, which again, as we discussed earlier, to talk about investments hypothetically is more complicated than in a specific investment. So this is an investment in a company in Finland, actually, which does thermal wood manufacturing technology. And they are able to thermally modify wood to have the same tensile strength of steel and cement. So as was mentioned in the morning, that people are moving towards green cement, but limestone effectively is a one-time use, and it takes 1 million years to get limestone, which is a core for the cement industry. Whereas if you're doing softwood, you have a 5-year recycling cycle. And if you think of wood as a substitution for, as a building material, in my mind, the IC engine continued for over 100 years till people said, look, we should think about electric mobility and try to change the paradigm. I think green buildings, this is about time that people rethink the material consumption of steel and cement. And wood is a contender to the extent that you can do sustainable forestry. And that's a longer conversation, which you can have off stage. But here, the concept is that, look, if you can, through technology, give wood the strength of steel, and it can substitute even 30-35% of building material. I mean, there's an IFC report which says that 75% of buildings in India that will be built by 2035 are yet to be constructed. So there is an immediate application, if you will, to see how we can incorporate a rethink. I think for venture investing, rethink is a core paradigm, as opposed to this is mature and let it take the 800 buses to 1500 buses, which has a different capital source and a different mode of investing. Whereas we are saying, how do you change the paradigm? How do you change the dialogue to say, look, instead of figuring out whether the cement should be transported 50 kilometers or 100 kilometers, we say, look, how can I use less cement? So alternate materials is another thesis to build on, to say, look, how do we think about things differently to address the problems of climate, and say that we are moving from incremental change to clearly a fundamental rethink of how we address a problem. And that's where a lot of our energies, effort, and time goes. I'm on the board of this company. We're trying to shift manufacturing to India, because if you can combine their technology and fabrication in India, you have a product for the world which is effectively 40% lower cost. And if you take the solar example, adoption increases as the cost decreases exponentially. So the point is, if we can intervene and see how we can bring down production cost of this machine, we are in discussion with the company in Ahmedabad, which might produce it for them. So you have the technology that has been built over 15 years, which we have entered as board members and revolutionize it. We're talking to people today in basically New Zealand, Australia, Africa, Switzerland, Canada, and India. This is a global opportunity. See, one thing we talk about India, but the 424 parts per million of the carbon that we are talking about is there's this one world and one planet, as we were talking about earlier. Anything that we do or don't do impacts everybody. So if we can find a solution that is global and in India as well, because we are building buildings in India at an accelerated pace over the next 10 to 15 years. Those are the kind of game-changing innovations that will effectively lead to value creation.
Yeah, I mean, I think that's quite exciting. The idea that India will potentially, I mean, it's, we've seen it in the tech space already. India has exported innovation, or we're starting to export in payments, it's innovation to the world. It's completely logical that these leapfrogs can be made here and that the solutions here will also serve the world. Anjali, do you want to jump in?
See, we have a great track record of leapfrogging in India, and it's emerged out of necessity. So we have leapfrogged the whole fixed line telephony to now having the lowest cost, largest data network in the world. Una, you mentioned, right? We have leapfrogged plastic payments. We've gone from cash to the ubiquitousness of UPI. So you have 700 million smartphones. You have your average smallholder farmer is also using a phone app. People are downloading YouTube in, forget tier 3, but even rural India. 65% of our portfolio operations actually are in tier 3 and rural India. And these are not social sector companies that are operating rural. Right? There's a big market there. So we believe in the market. We believe in technology. We know that India has the ability and a history of leapfrogging. We also hear from our friends around the world that the global north will have some solutions. The global south is where the large part of population lives. Globally, right? We have some of the most vulnerable populations in the world here. So it's not enough to think about carbon alone. So, you take the COP framework, take mitigation, adaptation, resilience. A lot of the work in the north happens on mitigation and carbon. we have to think about adaptation and resilience, which is fundamentally around business models and creating supply chain resilience. So I'm going to say that we need the 300 to 3,000 buses and then 300,000 buses. We also need the new technologies that we can import and export. I think for us, the very exciting piece is in India for India. Hey, you're solving for 20% of the world, right? So it's not small. The air we breathe is a global system. Water is a planetary system. You're solving for the planet if you solve for India. So in India for India, in India for the world. And we must remember 80% of emissions are in scope 3. Scope 3 is a problem few people talk about, I think, because nobody has a solution. Scope 3 in markets like ours is fragmented supply chains of SMEs and smallholder farmers. And how are we going to solve for them? It's not a social problem alone. It is actually one of the most fundamental problems, whether it is creating affordable, frugal technology. Fortunately, IoT costs and sensor costs are now low enough that you can put them into small farms. Solving for financing for this entire space. Small farmers, SMEs do not have the money or the wherewithal to invest in technology that will pay off 3 years later, right? They've got to meet their budget for next month. So I think addressing scope 3 challenges in India can solve for the world.
I'd like to ask, I mean, we started off this session asking, you know, where is the money? And we've all agreed that there's plenty of opportunities here. There's good returns to be made over a reasonable time frame. And there are good partners you can get together with. We've seen a lot of the big global funds commit a lot of money to Europe, to US. What is it going to take to bring that money here? What are the barriers to bring that here? I mean, I'm sure all of you in your own ways have experienced or have stories to tell from trying to raise your own funds. Maybe some thoughts on that would be helpful. And then I'd like to just quickly see if there's any audience questions.
Well, look, I think first of all, the India investment problem is a broader problem. India, generally, if you look at it as a country, while we do have a high rate of savings, a lot of the savings are today absorbed in, you know, whether it's the government as a large borrower or, you know, it's generally absorbed in other ways, largely to basically sustain the economy. So new capital that generally needs to be put to work to build largely is coming from global markets, right? It's not all bad because we've seen over the last 10 years, the private capital markets have grown from 5 to 50 billion. So clearly the world has recognized that India is an interesting place to put money to work and make money. India will continue to show strong economic growth. So therefore the alpha that we will generate, if you add the real growth plus the, you know, the inflation, and you add some factor, you will see at least a 15-20% alpha growth in the Indian economy. The problem is, I would say, a little bit more macro. India continues to trade at a fairly high risk premium. And two, India has the drag of a currency which depreciates. Now, when global investors have to look to relatively put money to work, India is within that relative portfolio, a market where they have to take these two things into consideration. So the need for generating a higher alpha in India is what is going to drive more capital to the Indian markets. Now, within that, then you add the whole climate conundrum, right? Is climate really going to make money? Is it at a stage where you can put capital at scale? If you can, how do you basically take that capital out? And you've got all the other questions that typically global investors need to deal with there. So I do think it's a little bit, I would say, two-pronged. One is that we as a country have to communicate a lot more about the strengths, and hopefully the global markets risk perception on India comes down as a result of that. And two is we need to also start tapping into local sources of capital, which today is highly restrictive, right? Because equity as an asset class, most pension funds are not allowed to invest. If so, also it's literally. And globally, if you see, one of the biggest investors in equity as an asset class, pension funds. So a lot of, I would say, structural kind of a alignment has to happen, that if you can't just have global, but even local flows having to come in to basically drive this change and drive the kind of, you know, access of capital. The second is really about pricing climate risk properly. I think one of the big challenges in the current banking system is that there is very little knowledge of how to price climate risk. There are comments made around steel and green steel and cement and green cement. And if you really start pricing, and I think Europe is leading the way. It's today, if you need to export to Europe, there's a tax. If you're not a green steel producer, right? It's a pretty significant number. And if you add that to the cost structures of most companies today in India, you'll actually see a very different profitability profile than what it is. Now, if the bank or a lender starts looking at it, if they start pricing that into the risk, and therefore the risk premiums they will apply is different. So there's a lot of those, I would say, the taxonomy, the way you price, the way you kind of project your, the country as a whole, and clearly the opportunity to invest over here. If you put all of that trajectory, I would say depends on where the trend line is, it this or this, but I think the trend line is very clear. We'll see a lot more capital flow here.
I could not agree more. Dhanpal and I do this sort of jugalbandi from time to time, right? And I think this is the umpteenth time that we are finding ourselves, and very happily so, together. I think it's never been a better time to invest in India with all our other issues that Dhanpal has already mentioned. I think some of the things that are working in our favor today, geopolitically, India is very well placed. We are seen as probably a more responsible partner geopolitically. So that's one of the things. Climate is finally coming of age. There is an overhang from the last clean tech cycle. So that does continue. There is a risk premium to the country. At the same time, I think there's a little bit of an overhang on this sector. So there is some confusion that some folks might have, this is ESG, this is impact, what is it? Is it CSR? So you have to be able to say, listen, CSR is 2% of your profit. Sustainability is 100% of your revenue. So it's a much bigger opportunity than creating impact. And of course, if you are investing in a market like India, everything should create positive impact, right? So there's that. 80% of capital that goes into Indian startups today, 80% of VC funding is of foreign origin. We actually want that to grow. We don't want to diminish that at all. We actually want even more receptivity, more foreign capital coming into India, but we also need domestic capital to get mobilized. We are starting to see private participation and I think there are several funds that have been raised that are completely domestic capital. So that's great. You're starting to see alternative asset funds emerge as a real asset class for personal finance portfolios. What we have yet to see, and we would like to see more of, and from IBCA, we are doing a lot of work in that space, is mobilization of domestic institutional capital. The insurance companies, the pension funds, and Dhanpal mentioned, globally, those are the largest investors. You see, what we are also losing out on as a country is that 80% of our returns go overseas. So we want to capture some of that wealth here in itself. Our entrepreneurial ecosystem, startup ecosystem is delivering good returns. We should do more domestic participation in that.
That's a really great point about, the money's coming from overseas, the returns are going overseas.
We want the whole pie to grow. We want more foreign capital, but we also want more domestic capital.
Yeah.
So just to add, I agree with what Dhanpal and Anjali have said. Just to add two more things, is like climate investing is still new. And I think what it needs is to show successes. I think people are comfortable investing in deep tech and fintech because that has been around. So I think for us, it is to stay the course and say this is a game for patience. And we are looking at this for the next decade. And I think as we see more success stories, some in our portfolio, some more broadly as well, I think the space will attract the capital that is required. The problem is that, look, the need is now. Everywhere you read, you said 2030 is the year when planetary boundaries are crossed and you exceed the 1.5 degrees and there are changes which are irreversible. So the question is, will it happen, as was mentioned in John Doerr's book, at a speed that we care about? Because if it happens too late, it may not be the effect, it may not generate the effect that it gets actually. One other point unrelated to this that I want to make, there's been a lot of discussion on net zero. So when we think about climate, it is a much broader perspective than net zero. You have to think about the natural capital outcomes, which include how are you dealing with fresh water? How are you dealing with wastewater? How are you dealing with air pollution, which is what Ashish mentioned? How are you dealing with land use change? How are you dealing with, so many other factors that require a proper consideration. So I guess the one caveat I would say is that the race to net zero should not lead us to not focus on attention on problems such as water, where we have 4% of water, 17% of population. And it's not only the quantity, but also the quality of water, how we manage waste, how we look at land use change, which goes to Anjali's point about agricultural. How do we think about it? How do we think about plant protein replacing, animal protein? So there's a broader conversation to be had on climate. And sometimes the single-minded focus on net zero diminishes the importance of the other sectors, which I just thought that the audience, I just wanted to make that point.
Can I say something? I think we'll hear from Jayant Sinha later today. And he talks about how net zero is not zero, it's actually net positive and the green frontier. I want to share something that makes us very optimistic, right? So we are early stage venture investors. We are optimistic by nature. My younger son and his generation, and they're all going into college now, he actually switched his choice of college because Stanford announced their climate school. So this generation sees this as a real opportunity, not just a problem to be solved, but as a real opportunity. So we will have some of our best, brightest young people, and many of them are in the room today, and I know some of them. I'm privileged to know some of them. I think they are going to solve this. We are merely enablers and hopefully positive catalysts in that journey.
Would you like to make any closing remarks?
Well, lots been said already. I think we should ask.
Is there anybody who would like to ask a question? We've got a couple of minutes before we wrap up, and the panelists would be happy to take one. I can't really see anybody's hands. I can't see anybody. So, is there anybody? No? We have a shy room of very attentive listeners, but I heard some laughs, so I know they've been listening.
We should do some cold calling.
We should do some cold calling. Well, I have one sec. I have a question. Oh, we have a question. Sorry, it's over there. Can someone get her a mic?
We have been talking about entrepreneurs, investors. What do you think is the consumer's role in all of this, and how we are doing that behavioral shift that is needed in the mind of the consumer? Any thoughts on that?
Thank you.
So I think, it's a great question because, I do believe that there are 4 C's which are going to drive climate change. It's the country, the corporate, the consumer, and the capital. And on the consumer end, I think it's eventually going to be about delivering value where people will want the right value. But at the same time, as you price it competitively, you're also basically telling them the story behind that, right? Which is essentially you're delivering something good. And the consumer choice today is, as long as it's reasonably competitive, is to choose good over just price. And we're increasingly seeing that, as Anjali rightly put it, the next gen is very, very conscious of that. But I do believe that even the current generation is now finally beginning to talk climate in the mainstream, in the language, rather than basically as something which is a sideshow.
I think just a quick comment. Consumers can effectively influence outcomes through voting through their pocketbook in terms of buying products from companies that are viewed as sustainable. And globally as well, investment in mutual funds like this generation, by the younger generation, is determined by, where is the fund investing in. There was a survey done at World Economic Forum where 78% of youth said climate is important to them. So going to Dhanpal's point, there's extraordinary evidence to say that the younger generation is much more, I guess, fortified with knowledge, but also keen to do something about it. But it has to be reflected in behavior. Ultimately, the consumer buys a product. So it's more like, as long as anybody buys a plastic bottle, somebody will make one. So, you have to determine how your choices are that determine ultimate outcomes.
See, and it's not a trade-off. People talk about the people-planet trade-off. It's not a trade-off. It has to be a people-planet profit balance. Someone's got to pay for it. Right now, consumers are less willing. Sometimes they're more willing, but generally, unless it is a competitively priced, better product, so it has to be better and better priced. There's only so much that shareholders will bear in terms of cost from the margin that a company will have to then absorb. There's generally a 5 to 15% difference in cost in COGS as you move into a sustainable alternative. And as I've mentioned before, our supply chains don't have the ability. So somewhere I think that balance, it's a balanced equation versus a trade-off equation.
Well, listen, thank you very much. Our time is up. But I think if the younger generation are excited about climate change and all the opportunities that come with that, I think you have certainly excited the room about climate investing and made us think that that is an opportunity rather than something rather totally scary. So thank you very much, Dampal, Anjali, Samir.
Thank you.
Thank you.
Thank you very much. So there's two